So is a stock that is down nearly 40% year to date and plagued by a massive, paralyzing cyber attack, a screaming sell? Or, when Warren Buffett suddenly scoops up 5 million shares out of nowhere, is it actually the ultimate undervalued buy?
I mean, it is literally the defining puzzle in the market right now. You have just sheer, unadulterated panic on one side, and then these billionaire value investors calmly stepping into the chaos on the other.
Right. Which brings us to welcome you to today's deep dive. Our mission for you today is to unpack the chaotic, honestly incredibly fascinating current state of UnitedHealth Group, ticker symbol UNH.
Yeah, UNH, which, is basically the central nervous system of American healthcare.
Exactly. A company caught in this hurricane of bad news, yet suddenly attracting massive institutional capital. Now, before we start breaking down the numbers and the controversy, please remember to like this video, subscribe to our YouTube channel, and definitely leave your feedback in the comments.
Yeah, it really helps.
It really helps the show, and we genuinely rely on your input to shape these discussions.
And right up front, we need to establish a very firm boundary for you listening. The discussion we are having today is a purely educational analysis of the source materials provided.
Right.
We are just examining market data, natural debates among investors, historical context. It's sentiment analysis. This is explicitly not financial advice.
Right. We are just here to help you decipher the noise. So look, before we get into the high-stakes drama of federal probes and, cyber attacks, we have to look at the actual scoreboard.
Yeah, you have to.
We need to understand the physical scale of the business we are dealing with here. As of our data, UNH is sitting at around $322.50 a share.
Right.
It's up like 1.9% for the day, which sounds like a decent green day until you zoom out and see it is down nearly 40% year to date.
Yeah, it's brutal. To put that drop into perspective, look at their 52-week range. We are talking about a massive structural swing in valuation here.
Just huge.
Over the past year, the stock is traded as high as $453.50 and as low as $234.60.
Wow.
I mean, that level of extreme volatility is something you might expect from, I don't know, a speculative tech startup trying to find product market fit, not a mature, entrenched healthcare conglomerate that touches literally almost every part of the medical sector.
Yeah, I look at that chart and I just see a company in crisis. But then, you look at the actual income statement, and the sheer volume of money moving through this entity is just staggering.
It's unbelievable.
Can you walk us through the actual baseline financials here? Like, what does the engine look like under the hood?
Well, under the hood, the engine is just massive. For the full year of 2024, UnitedHealth reported total revenue of $400.3 billion.
Wait, 400 billion?
Yeah, with a B. $400.3 billion. That represents an 8% year-over-year increase, actually.
Okay, wow.
And their net income for the year was $14.4 billion. Now, if you look at the balance sheet through December 2025, they're holding total assets of $313.7 billion.
Right.
And that's against total liabilities of $215.5 billion. But the number that really jumps off the page is their cash position. They're sitting on $24.4 billion in liquid cash.
24 billion in cash just sitting there.
Just sitting there.
I mean, that is larger than the gross domestic product of some entire countries just sitting in a corporate bank account.
It really is. Yeah. And the mechanism driving that massive stockpile is their operating cash flow. In 2024, their actual day-to-day operations generated $24.2 billion in cash.
Okay.
If we look at financial health metrics, that provides a 1.6 times coverage of their net income.
Let me pause you right there, because cash flow coverage of net income is one of those terms that can completely glaze over someone's eyes if they aren't an accountant.
Fair enough, yeah.
If I'm understanding the mechanism correctly, this metric basically proves that the earnings they report aren't just like clever accounting tricks.
Exactly.
It means physical dollars are actually entering the bank accounts faster than they are claiming on paper. Is that right?
That's exactly right. It's precisely the opposite of an accounting illusion. And, for income-focused investors, that cash flow supports an annual dividend payout of $8.84 per share.
Which is pretty solid.
Yeah, giving it a yield of about 2.72%.
Mm-hmm.
The core operations, collecting monthly insurance premiums, providing care services, managing massive pharmacy benefit networks, they are still actively generating immense cash.
Right. So I visualize that $24 billion in operating cash flow like like a massive ocean liner.
Okay, I like that.
Right. It takes an absolute ton of fuel and capital to run a ship that size. But its sheer physical mass and forward momentum provide an incredible structural cushion against rough seas.
Yeah, it has a ton of inertia.
Exactly. If a rogue wave hits a speedboat, the boat just capsizes. If a rogue wave hits an ocean liner, the ship shudders. Maybe some plates fall in the dining room, but it essentially just plows straight through the water.
Right. The ocean liner is definitely still moving. But a 40% drop in the stock price indicates the market believes that ship isn't just dealing with rough seas.
It's actively taking on water.
Yes. The market is pricing in structural damage right now.
Which naturally forces the question. If the revenue is over $400 billion and actively growing, what hit the hull? Like, why is the stock down 40%?
Oh.
Let's get into the bear case, because the headwinds here are severe and they are really complicated.
They are. So the most immediate way to hit the hull was the Change Healthcare cyberattack. And we need to be really clear about the mechanics here. This wasn't a standard data breach where, some passwords got leaked on the dark web.
Right. It wasn't just a phishing scam.
No, not at all. Change Healthcare functions essentially as the central nervous system for medical billing in the United States.
Yep.
It is the digital clearinghouse.
Oh, wow.
Yeah. When you go to a pharmacy or a hospital and they run your insurance to see what you owe, that data routes through Change Healthcare.
So when the hackers paralyzed that specific network, they didn't just steal data. They basically froze the entire financial plumbing of the American healthcare system.
Exactly. Frozen. Doctors couldn't submit claims. Hospitals literally stopped getting paid.
That is terrifying.
And because UnitedHealth owns that clearinghouse, the financial blowback on them is just massive. I mean, they had to advance billions of dollars in interest-free loans just to keep rural hospitals from going bankrupt.
Wow, they had to float the hospital.
Right. Plus, they are paying for the forensic IT cleanup, the ransom negotiations, the total system rebuilds, and, of course, the inevitable legal settlements.
Lawyers always get paid.
Always. UNH estimates that the cyber attack alone is acting as a direct hit to their profitability, costing them between $1.90 and $2.05 per share in 2024 alone.
Okay, so that explains a huge chunk of the financial pain. But frankly, Wall Street is incredibly cynical.
Very.
They can usually calculate the cost of a cyber attack, deduct it from the balance sheet, and just move on. The element of the bear case that seems much harder to digest is the Department of Justice criminal investigation.
Yeah, that's the big one.
Our sources indicate the DOJ is focusing on their bullying practices, specifically regarding, quote, Medicare Advantage concentrations. What is the actual mechanism at play there?
Okay, so this is where the real structural risk comes in. Medicare Advantage is essentially the privatized version of Medicare.
Right.
Instead of the government paying for each individual doctor visit, the government pays a private insurer like UNH a lump sum per patient every single year.
Got it.
Now, the crucial mechanism is that the government pays more money for patients who have more severe, complex diseases.
Oh, I see where this is going. So the incentive for the insurance company is to identify every possible illness a patient has, because each diagnosis code increases the monthly check they get from the government.
That is exactly the theory.
Yeah.
So the DOJ criminal probe is likely investigating whether these insurance companies are engaging in what's called upcoding.
Upcoding.
Yeah, which basically means artificially making patients look much sicker on paper than they actually are in reality, purely to extract larger payments from taxpayer funds.
Wow, that's a huge deal.
Huge. When the DOJ opens a criminal probe into the very mechanism that drives your most profitable growth engine, it absolutely terrifies the market. A cyber attack is a one-time cost, right?
Right.
But a federal probe threatens to permanently alter the regulatory framework of how you generate revenue. Naturally, this has already triggered multiple securities class action lawsuits from furious shareholders.
Yeah, I have to push back on the idea of investing in this right now. I mean, put yourself in the shoes of a portfolio manager analyzing this risk. We have a DOJ criminal probe hanging over their main profit center. We have a cyber attack costing billions. And on top of all that, we have severe internal instability. I mean, their CEO suddenly resigned and management completely suspended their 2025 financial guidance.
Right.
Wait, a DOJ criminal probe, a resigning CEO, and they suspended their guidance. Isn't that the ultimate triple red flag? How can any rational investor confidently price a stock when the company itself refuses to estimate what it might earn next year?
The short answer is many institutional investors simply can't. Suspending guidance is, it's basically the corporate equivalent of turning off your headlights while driving down a winding mountain road at night.
That's a great way to put it.
It violates the core requirement of institutional modeling, which is predictability. When a company pulls guidance, major funds are often mandated by their own internal risk protocols to just sell the stock and flee to safer assets until visibility returns.
Wow. And that institutional flight creates an environment for what our sources call the retail trap. Can you explain the psychology of how everyday retail investors get caught in this scenario?
Yeah, it comes down to a really common cognitive bias known as anchoring.
Okay.
A retail trader pulls up the chart for a famous blue chip ticker like UNH. They see the 52-week high was over $450. Then they see it is currently trading at $322.
Right. They see a sale.
Exactly. Their brain anchors to that previous high, and they think, oh, this is a massive discount. I'm buying the dip.
They just assume the stock mathematically has to return to its previous peak.
They assume the fundamental business is exactly the same as it was when the stock was at 450. They don't fully grasp the complex downside mechanisms.
Like the DOJ probe.
Right. They underestimate how a DOJ criminal probe can drag on for 3 to 5 years, literally suffocating the stock's momentum. They underestimate how profoundly the suspension of guidance locks institutional buyers out of the market. So they step in front of a falling freight train, assuming the brakes are about to engage, and they just get crushed by the ongoing momentum of the sell-off.
Okay, so the bears are arguing that the structural integrity of the company is currently compromised. Leadership is in flux, the government is knocking at the door, and cyber costs are bleeding the margins.
Right.
That makes total logical sense. But, despite all that institutional flight, the biggest fish in the entire financial ocean is swimming right toward this chaos. Let's look at the bull case.
Yeah, let's pivot to the bulls, because the primary catalyst propping up the bull thesis right now is Warren Buffett's Berkshire Hathaway.
Right.
Out of nowhere, Berkshire recently purchased 5.04 million shares of UNH.
Which is just wild. I mean, when Berkshire Hathaway allocates capital, it forces every other analyst to reevaluate their thesis. How does a purchase of that magnitude fundamentally change the market narrative here?
It acts as an incredibly powerful psychological signal, particularly to the broader value investing community. I mean, Warren Buffett's entire philosophy is built on ignoring short-term momentum and calculating long-term intrinsic value.
Right.
When he buys 5 million shares of a stock that is being battered by terrible headlines, he is explicitly signaling his belief that the current market price has severely over-discounted the risks.
He's basically saying the panic has driven the price lower than the actual mathematical damage warrants.
Exactly.
I look at Buffett's strategy here through, like, a real estate analogy. Imagine a massive, beautiful, highly profitable apartment building in a premium neighborhood.
Okay.
But right now, the roof is caved in from a storm, and the city is aggressively auditing their building permits. The current owner is in a total panic, overwhelmed by the immediate lawyer fees and repair costs, so they just list the building at a 40% discount just to escape the headache.
And the value investor calmly steps in to buy it.
Exactly, because the value investor understands the mechanisms of time. They know roofs can eventually be repaired. They know city audits eventually conclude, usually with like a negotiated fine.
Right.
They look past the current wreckage and see the underlying bones of the property. They calculate the cash flow that building will generate 10 years from now once the temporary problems are cleared. Buffett is betting that the $24 billion cash flow engine of UNH is far more durable than the temporary storm of a DOJ probe.
That is the exact mechanism of finding a margin of safety.
Yeah.
And, the bulls recently received another structural tailwind, too.
Oh, what was that?
We got regulatory clarification from the government regarding a 2.48% rate increase for Medicare Advantage.
Okay, wait. Why does that specific percentage matter? 2.5% doesn't sound like a massive windfall to me.
It's not about the size of the increase, actually. It is entirely about the removal of tail risks.
Ah.
See, with the DOJ probe making headlines, the market was terrified that the government was going to take a really punitive stance and actually slash Medicare Advantage reimbursement rates.
Which would be catastrophic.
Exactly. If the government cut rates, it would permanently compress the profit margins for every single patient in the system. So a 2.48% increase might just barely keep pace with medical inflation, but it proves that the core regulatory revenue stream remains stable.
It basically takes the worst-case scenario, a punitive rate, cut completely off the table for now.
Exactly.
So we have these two massive opposing forces, the structural risks of the bear case versus the long-term value calculations of the bull case. Let's move away from the narrative for a second and look at what the actual technical charts and Wall Street analysts are signaling right now. Where does the technical momentum stand?
Well, looking at the short-term indicators, the stock is currently attempting a really strong technical bounce. It is currently trading above its 200-day moving average, which sits at $312.62.
Okay, and for the listener who might not use charting software every day, the 200-day moving average is essentially a mathematical smoothing of the stock's long-term trend, right? Crossing above it generally signals a breakout from a downtrend.
Right. It acts as a major psychological support line, especially for algorithmic trading programs. If it stays above that line, the algorithms basically view it as being in an uptrend.
Got it.
However, the short-term momentum indicators are flashing a massive warning sign right now.
Uh-oh.
The 14-day Relative Strength Index, or RSI, is currently sitting at an astonishing 94.00.
Whoa, let's explain what that actually means, because an RSI of 94 is wild. Usually an RSI over 70 is considered overbought. What is the mechanism behind this indicator?
So the Relative Strength Index measures the speed and magnitude of a stock's recent price changes. It essentially asks, over the last 14 days, how aggressive was the buying volume compared to the selling volume?
Okay.
An RSI of 94 means the buying pressure has been violently, aggressively one-sided, just nonstop buying.
I think of the RSI like a physiological metric for a runner. Imagine an Olympic sprinter running the first 200 meters of a 400-meter race and at a world record blistering pace.
Okay, I see where you're going.
They look incredibly strong, right? But physiologically, the mechanism of their body is rapidly changing. Lactic acid is flooding their muscles. Mathematically and biologically, they cannot sustain that exact pace for the rest of the race.
Right, they have to slow down.
Exactly. An RSI of 94 is a stock heavily flooded with lactic acid. It indicates tremendous short-term strength, but it mathematically guarantees an impending slowdown or a sharp pullback as traders inevitably take their profits.
That's a great analogy. The momentum is simply stretched way too far, too fast. But while the short-term charts suggest a pullback is coming, the long-term analyst community remains largely optimistic.
Really? What are they saying?
The consensus rating on Wall Street right now is a moderate buy. The average price target sits at $360.46. And we are even seeing some aggressive outliers from major firms.
Like who?
Bernstein, for instance. They recently published a research note raising their target all the way to $411.
Wow. A $411 target implies a massive recovery. But the piece of data that really stood out to me in our research was the valuation modeling.
Oh, the DCF model.
Yeah. When you look at discounted cash flow models, like the institutional ones run by Simply Wall Sister, they suggest the stock is heavily structurally undervalued.
Very undervalued.
They estimate it is between 33 and 65% undervalued, placing its actual intrinsic fair value somewhere around $486.86.
Yeah, and to understand why that number is so high, you have to understand the mechanism of a discounted cash flow, or DCF, model.
Right, break that down for us.
A DCF model is entirely emotionless. It does not read the news. It does not care about the DOJ probe or the CEO resigning. It just treats the company as a mathematical machine.
Just raw numbers.
Exactly. It projects how much actual cash that machine will print over the next 10 years, figures out what that future pile of cash is worth in today's dollars, and then divides it by the number of outstanding shares.
It strips away all the market psychology and panic and just looks at the raw earning power of the underlying asset.
Exactly. And when a mathematical DCF model outputs an intrinsic value of $486, it is essentially validating Warren Buffett's entire thesis.
Wow.
It mathematically confirms that the fundamental cash-generating engine of UnitedHealth Group is completely disconnected from the current, depressed, panic-driven stock price.
Which brings us to the ultimate synthesis of this deep dive. You have these severely conflicting realities. Is this a generational buying opportunity? A truly undervalued giant temporarily stumbling, or is it a value trap?
Right. Is it a falling knife?
Exactly. Is it a structurally damaged company that is just going to keep crushing anyone who tries to catch the falling momentum? To answer that, we really have to look at the timeline, because the short-term and long-term outlooks here are practically in two different universes.
They absolutely are. They require entirely different risk tolerances from an investor.
How so?
Well, in the short term, investors have to brace for extreme whiplash volatility. Institutional attention is intensely focused on the upcoming Q2 results, which are scheduled for July 29, 2026.
It's coming up fast.
It is. And analysts are bracing for a brutal quarter. They are forecasting a worst-case continuation lower, projecting a 25% year-over-year decline in earnings per share.
Wait, 25%?
Yeah, dropping it down to $5.08 for that quarter alone.
I really want to break down the mechanics of a 25% drop in earnings per share because that is the kind of number that forces major funds to liquidate their positions entirely. How does that happen to a company bringing in $400 billion in revenue?
It happens through sudden margin compression. Think about it. The company's operating costs, like paying doctors, maintaining buildings, funding employee salaries, those are relatively fixed.
Right.
But suddenly, you have to absorb billions of dollars in unexpected one-time charges for the Change Healthcare cyber attack.
The forensic IT teams, the crisis PR, massive legal retainers.
Exactly. All those unexpected costs eat directly into your profit margin. So the revenue at the top might stay exactly the same, but the actual earnings left over for the shareholders at the bottom just drop off a cliff.
So July 29th could be an incredibly ugly day for the stock. If that EPS drop actually materializes, that overheated RSI we talked about is going to snap back so hard.
Right. That is the immediate value trap scenario playing out in real time. The legal fees, the uncertainty, the cyber costs, they all crystallize in that Q2 earnings report.
But there's a flip side.
There is. Because the long-term outlook requires looking past that specific quarter. The best-case recovery scenario relies on the underlying resilience of the healthcare system and management's internal projections.
What are they projecting?
They believe that once the extraordinary one-time costs of the cyberattack are fully absorbed and finally placed in the rearview mirror, the core business can easily return to a 13 to 16% long-term earnings growth rate.
And there it is. That is the ultimate tension of this entire debate. So I have to ask you, the listener, to really weigh these two opposing scenarios. Put yourself in the shoes of someone allocating capital right now.
It's a tough spot.
Can you stomach a forecasted 25% drop in earnings this coming July? Can you watch the stock potentially swing wildly as the DOJ issues subpoenas, all for the distant promise of a 15% long-term growth rate once the dust settles years down the line? It is a test of absolute, unwavering conviction.
It really perfectly encapsulates the classic struggle of capital markets. I mean, the market is constantly, nervously weighing immediate painful realities against hypothetical future recoveries.
Right.
The DOJ investigation could easily drag on for years, imposing massive structural changes to how they operate Medicare Advantage. Or, the company simply uses its $24 billion in operating cash flow to pay a negotiated fine, upgrade their digital security infrastructure, and go right back to dominating the entire American healthcare space.
It is a phenomenal real-time case study in market psychology versus fundamental value. To briefly recap the incredible tension we've unpacked for you today, you have UnitedHealth Group, an undisputed giant generating over $400 billion in revenue, sitting on massive cash reserves.
Right.
But it is currently wrestling with severe federal criminal probes, debilitating ongoing cyber costs, and a total vacuum in leadership guidance. Yet, sitting quietly on the other side of the trade, systematically scooping up millions of shares, is the world's most famous, disciplined value investor.
It just highlights why navigating modern markets requires moving far beyond just reading the daily headlines. And as a final reminder, the natural debate we've walked through today was an educational analysis of market mechanics and public data.
Exactly. It was not financial advice.
Please don't take it as such.
Do your own research, understand the mechanics of the businesses you follow, and map out your own risk tolerance before you step into a volatile market. We've covered the numbers, the regulatory mechanisms, and the technical signals. But I want to leave you with a provocative thought to mull over as we wrap up.
Let's hear.
If Warren Buffett, a man absolutely legendary for meticulously avoiding unpredictable, unquantifiable risk, is willing to confidently weather a criminal DOJ investigation and the suspension of company guidance, what fundamental, unshakable truth about the future of the American healthcare landscape does he see that the panic sellers are completely missing?
Now that is the multi-billion-dollar question.
Think about it. Thanks for joining us on this deep dive. We'll catch you on the next one.